Hello, everyone. So, a little bit of good news. The mask is mostly for show. I don't think that I'm spreading anything or contagious. I'm just not taking any precautions. You can probably tell from my voice, it's not nearly 100% yet. We're gonna see what happens today. When I was doing AIS today, only had to really teach for 30 minutes because we were reviewing homework, and that took a lot of effort. So 50 minutes may be a bit of a challenge. Also, I'm feeling the effects of the medicine that I'm taking, so I'm a little bit groggy. So much like everybody in this class, I really want a nap right now. I just really, really want a nap because it's about that time of day and the medicine. I've been wanting a nap all day, just to be honest. So yeah. But the simple truth is that it's the very last lecture. I didn't want to miss out on this last lecture of the semester. So I'm going to do my best to power through it and get everything done here. Before we get started on our last and final lecture, I have several announcements to make sure everybody's updated on. So we are on the 16th today. So 2 days from today, our professional interactions are due, or I should say your professional interactions are due. If you've completed those already, thank you very much for submitting. If you've not, you've got 2 days to submit. About half the class, I think, is still needs to do that. So please make sure you complete that. Just like the interactions you did in AIS, one paragraph about what the presentation was about, one paragraph about what you learned. Coming up, since this is the last last lecture, we've got homework on Friday. Then we've got exam. So on the homework, I did want to make a note on the homework. For the earthwork clothiers assignment, it's a chapter 16 assignment. It is a very large spreadsheet. The instructions in the instructions on Brightspace tell you do not submit the spreadsheet. Okay, it's a very large file. There's no reason to clutter up Brightspace with a lot of space. Instead, make sure you fill out the evaluation tab of the spreadsheet and save that, and then provide a written summary of what you did in the Excel file. That's all you have to do. You don't actually need to attach the entire Excel file. We'll walk through the Excel file on Friday, but it's a large Excel file, which sounds like it's going to be a lot of work. It actually isn't. It's actually a pretty minimal amount of work given all the numbers. It's supposed to be illustrative tabs of a workbook. So please make sure you do not submit the entire workbook. If you submit the full workbook, I will be sad. Exam next week, we'll be back in on Wednesday. Wednesday will be the exam review, just as before. We'll do the study guide, and then we'll talk about the practice exam. And then Friday we'll have the exam itself, and then we'll do the exam discussion on the Monday of week 14. That'll lead us into the presentations. I still have two groups who have not selected presentation topics. So we've updated the information on Brightspace. One group has selected current technology trends in auditing. Another one is going to be discussing data analytics. Those groups who have not selected, please get on it. I'd like to have those topics selected by the end of the week. If you're a group that does not select by the end of the week, I will choose for you, and I may choose soccer reports for one or both teams. So you have to compete on talking about soccer reports. So please make sure you talk to your group members and get that worked out. Last thing to note, on Friday, I suspect that there will be more than one person who will be saying it's a very long weekend effectively, because we have off, quote unquote, off tomorrow. And then there's going to be Friday, Saturday, Saturday, Sunday, and Monday will be off. So I suspect a lot of people will be traveling, which is fine. That's always fine. You don't have to attend here in person. But if you are not going to be in person in attendance on Friday, please let me know. Please contact me and let me know what's going on. You all are adults. I'll trust you to make your own judgment calls, but I do expect you to let me know if you're not going to be here in person. That's the only thing I ask. With that, let's get to the final lecture. What do you say? Final lecture? Enthusiasm? Don't make me get up and do the ray gun dance. I'll do that. I promise I will. Yeah. I don't care if I'm sick. All right. So what are we getting into? We're going to be talking about auditing and the financing investing process, part 2. So we talked about most of the balance sheet accounts, or at least you watched the video on the balance sheet accounts and the other items, and the talked about the nature of auditing the income statement. We have 2 special items that we have not talked about yet. We've not talked about cash, and we've not talked about investments. So to close the loop, that's what we're going to be talking about today. So as we've talked about already in this course, auditing cash is very, very easy. Which makes you wonder, if we're talking about auditing cash and it's very easy, why do we spend so much time on it? And the answer is, it is also very, very important. First of all, it's prominent in pretty much all business activities. Secondly, is a very, very attractive target for theft. So we're going to have to go down to a little bit of drilling and talk about what it is that we are concerned about with cash, what we already know, and what we need to learn moving forward. So let's talk about cash. What is cash? Well, you've probably seen on the balance sheet that it's not always just cash, but it's considered to be currency on hand, cash in bank accounts, which includes CDs, time deposits, and savings accounts. So anything that's in the bank or anything that represents currency on hand can be depicted as cash. But if you look at the 10Ks, usually when they characterize cash, they don't call it just cash. They call it cash and cash equivalents. So has anybody ever done any research in saying, what is a cash equivalent? I've always just been curious about that, what a cash equivalent is. Well, the good news is you don't have to, because I'm about to tell you what a cash equivalent is. So usually we consider these to be treasury bills or money market funds or anything by definition that's a short-term, highly liquid investment that is readily convertible to cash, or it's very near to maturity, so there's a low risk of the change in value. Now, usually we combine these on the balance sheet for presentation purposes, in the financial statement for presentation purposes. For the most part, we're going to consider anytime we're talking about cash audit procedures, those are going to be over everything that could be cash or cash equivalents, because effectively everything here that we're talking about is cash. As I alluded to, cash is really important because it hits all of the business process areas we've talked about so far. So we talked about revenue, we talked about purchases, we need cash for both of those. So presumably when we sell something, we want to receive cash. When we buy something, we need to give up cash. We talked about property, plant, equipment, or the issuance of long-term capital debt. That's when we those are items used to generate cash. Long-term capital debt or long-term debt or capital stock, excuse me. When we generate payroll, we have to pay our employees, and then we make purchases of inventory, property, plant, equipment. Also, when we rebuy long-term debt stockholders' equity, either as a repurchase of our own, or we buy that from another organization, we invest in other organizations. Basically, all of this is going to be associated with cash. So cash is basically omnipresent, so we can't ignore it. We can't just basically say it's an immaterial account because it's going to be effective everywhere. It's going to have a lot of activity. So what are the cash accounts that we're going to be concerned about? Primarily speaking, we're going to be concerned about the general cash account for most organizations. And for a small organization, usually this is going to be one bank account and it's pretty limited. For really large organizations, though, they're going to have a lot of different types of accounts. So the other types of accounts that we're concerned about are going to be impressed cash accounts, which you've probably heard that term impressed before. And by the way, it's not impressed as I'm very impressed with you. It's a different word, impressed. Impressed in this context means that it's cash set aside for a specific purpose. Cash set aside for a specific purpose. So an example of this is to say you have an outsourced payroll service and they dip into a specific account that you've set aside for payments of payroll. And an impressed account would be an example of a payroll cash account. So they set aside that cash account only for payroll payments, and that's it. That's all that that's all you use it for. And then something that's probably intuitive, but still worth talking about are branch accounts. So if we're an organization that's lucky enough to operate with just the same bank in one location, then we've got a pretty easy process ahead of us. But what about really large organizations like Amazon or Walmart's a really good example. Walmart, let's take that as an example. I don't know who our Walmart's primary bank account is, who their general cash account is. Let's say it's Bank of America, okay, just for hypothetical sake. So the Kirksville Walmart, if they're going to do any cash transactions, like they need cash for their business operations, they're going to have to go to Bank of America to get all their cash, right? Does anybody see a problem with that? The Kirksville Walmart going to Bank of America? How many locations, how many branches of Bank of America do we have here in Kirksville? Zero. We have 0 locations of Bank of America in Kirksville. So you just learned something about Kirksville. So they can't use that as their cash account, which means they'll have to open a branch account at another organization. Say that Equity Bank, US Bank, any one of those banks that actually is present here in Kirksville, they could operate out of. It's not their main bank account, but it's necessary for location purposes. They have to open up those accounts. All right, moving on. As far as control risk assessment goes with cash and cash equivalents, for cash receipts and cash disbursements, I've got great news for you all. You already know this, okay? We covered these in chapters 10 and 11. The same rules that we talked about for control risk are going to apply here as they do in those chapters, so we don't need to relearn that. That being said, we are going to talk about an additional cash control that I've alluded to already. I alluded to it last week. It's going to be the periodic, which is usually monthly, bank reconciliation. So I've got great news for everybody. In the past, what I used to do is I used to go back to 302 and I used to have everybody create their own bank reconciliation and audit it. So you don't have to learn how to redo bank reconciliations again. I'm assuming that you all do that anyway. You're pretty active in accounting. And so you say, you know what? I missed 302. I'm just going to do bank reconciliations for fun. So presumably you do that. I know a few of you still do bank reconciliations. I'm not lost on that, but it's important to understand that process. We're going to talk about how do we audit bank reconciliations. And so we're going to assume that the client actually performs the bank reconciliations. We need to understand what we're going to be doing for testing that control through auditing the bank reconciliation. Now, the good news is that the client has effective bank reconciliation procedures. The auditor may choose to test the entity's reconciliation procedures as part of its test of controls. So good news is we can rely on this, our control. We can rely on it as a control. That's going to give us more assurance over the cash process. All right, so we're going to talk a little bit more about the process for testing bank reconciliations here in just a little bit, because we're going to actually talk about it as part of the substantive test of details as well, because it kind of is a dual purpose test in that regard. But before we get to that, let's talk about substantive analytical procedures. There's our good friend Dwight Schrute to ask a question. Okay, does everybody know The Office? Know Dwight? Okay, I have already said that if I make a joke about The Office and somebody says I don't know what that is, Dr. Barnes, that's the day I retire. Okay. So I'm glad that a few people still nodded their heads. No, Dwight Schrute is. Question: does cash have a predictable relationship with other financial statement accounts? What do you guys think? Yes or no? That's a tricky one. It's like, well, yeah, if sales goes up, then cash goes up. But what about if purchases go up, then cash goes down? So we've got multiple accounts that are affecting cash. So the answer is false. False. Yes, because all these accounts are affecting cash, it's really hard to develop any kind of expectation with respect to cash, or any determination of what activity will look like, because there's so many forces acting upon cash. So substantive analytic procedures, by and large, are very, very limited of what we can use with respect to cash testing. Okay. So the auditor's use of substantive analytic procedures is generally limited to two areas: comparisons with prior year's cash balances, because we can actually look at trend analysis to see what happened. Even that one is not all that effective because, again, it's so volatile and things can change so quickly. And then the other one is going to be comparison with budgeted amounts. If we have a budgeted amount that's set by the organization of what their expectation of cash is, we can use that to actually measure performance in a given year. For the most part, I'm going to tell you that substantive analytical procedures and cash do not mix. They're like oil and water. They're like oil and water. Yeah. So probably not the best analogy, but the best one I can come up with. All right. Substantive test of details. Again, we're going to talk a little bit about this because we're going to go into depth. We can actually perform both the bank reconciliation as a test of controls and substantive test of details. So what does that entail? Well, it entails looking at all of our assertions that we've talked about before. So our transactions events, and you'll notice I listed authorization on here just to be consistent with the book, and then account balances, and I listed everyone, but then I cut out rights and obligations, which is an interesting concern. Why do we not need to worry about testing rights and obligations with respect to cash? What do you guys think? So it's because we're really, really tired of testing assertions, and we decided to randomly punt one. So you know what? I don't really like rights and obligations. It's not a real assertion. Authorization deserves to be assertion more than rights and obligations, Dr. Barnes. How dare you? How dare you? So no, cash is what we call a bearer instrument. Does everybody have ever heard that term before, a bearer instrument? A bearer instrument basically means that if you possess it, you own it. So cash ownership is determined by who possesses the cash. So that's kind of the idea. Now, can you actually claim rights to it? Certainly. A bank possesses the cash. They don't necessarily own the cash. They hold it in custody for you. But for the most part, anytime that you consider to be who has cash, it's whoever the bearer of that cash is. That's why rights and obligations is not considered to be a main assertion with respect to cash, because we're not concerned about whether or not we have the rights to it. If we own it, we have the cash to it. We have the rights to it. That's basically all there is to it. All right. So just as a recap, we can test all these assertions for cash receipts and cash disbursements. These are the same tests that we talked about back in chapters 10 and 11. If you don't remember those, you might want to review those and talked about a little bit about those or review that. It's fairly intuitive. Nothing particularly challenging is here. We're going to review that as part of the homework for this chapter, but I don't think it's particularly difficult. Let's get into the nitty-gritty of the details of how we're going to perform the test of account balances with respect to bank reconciliations. So For existence, we can confirm our bank account balance to the financial institution, and then for completeness, accuracy, or completeness in BAA, we're going to test the bank reconciliation for all of our accounts. And it actually walks through some steps here. You don't need to worry too much about these steps because I'm going to walk through these steps individually here in just a second. Some of the terminology I don't really like they talk about tracing here. It's not really tracing, but I'll talk about why. So what are the steps in actually performing this test? Well, let's think about the nature of a bank reconciliation. What is a bank reconciliation trying to do? So does everybody remember 302? You had two sections. You had the bank balance and the book balance, and you're trying to get those two numbers to agree with one another. The idea being is that your book balance tells you one number, your bank balance tells you another number. And if you're able to adjust for all the items that were different between those, they should actually match after all the reconciliations. That was the goal back in 302. Well, in audit, we're very concerned about whether the reported book balance is correct, okay? Whether the book balance is correct. So how are we going to validate that? Well, think about it from this way. If we can validate the bank balance, and then we can validate all the adjustments that occur to the bank balance to achieve the book balance, does that verify the book balance? So if we know the bank balance is correct, we know all the adjustments to the bank balance are correct. What does that tell us about the book balance? The book balance is correct, okay? So that's basically what we're going to be doing. So our first step, first thing that we need to do to test the bank reconciliation, we have to get a specific document. What document do you think we need to get in order to test the bank reconciliation? The bank reconciliation, very good. I'm glad you went with me on this journey. Okay, so we need the bank reconciliation, a copy of the bank reconciliation, which is going to be an example of this in here. The form of this is not territorially specific, but it's going to be consistent with the way we operate before. Again, the balance per bank, all the adjustments, the balance per book. We're trying to verify this number right here because this is the number that's in the financial statements. All right. So again, we said there's two steps in this process. The two steps in this process are primarily going to be verifying the bank balance. Is there any way that you might be able to think about how we could actually determine what the bank balance is? Is there a party we could reach out to that could, so we could say, hey, do you think you could tell us what the balance in the bank is? Maybe the bank, okay? So our second step is to send out something called a standard bank confirmation. This is a positive confirmation sent out to banks about cash balances. So we report the cash balance and they report back to us whether those balances are correct, which is going to tell us our top line. Then the next thing is going to be all these items in the middle here, all these things that are in the middle here. So some of these are pretty intuitive and straightforward, like deposits in transit, outstanding checks, and then adjustments that need to be made. Now, if there are adjustments made by the client, we don't need to worry about those because those will actually sort themselves out in the balance down here. If there are adjustments that the bank needs to be made, we assume that those have been reported to the bank and they will be made in the future. But what's true about deposits in transit and outstanding checks, okay? Let's assume that all of these outstanding checks and all of these deposits in transit are legitimate transactions. What is going to happen in the very near future? The very near future, we're going to be watching Netflix, and the next season of Cobra Kai is going on, even though it's the episodes are over. I'm not talking about that. I'm talking about specifically with those transactions. What's going to happen with those transactions? Will they clear the bank? If they're legitimate, presumably yes, okay, within a short period of time. What if we had the ability to look short into the very near-term future and see if these items cleared? Would that be helpful for us? Yes, and that's effectively what we're going to do. Our third document is something called a cutoff bank statement. So we look at the date of the bank reconciliation. We go to the bank and say, 7 to 10 days later, we're going to actually request a bank statement, our bank statement to say, can we actually see if those items have cleared? So we're going to look at the bank statement about a week in the future to see if all of those items that were on the bank reconciliation, those checks in transit or checks outstanding, those deposits in transit, all of those items have cleared. If they do clear, then we've got evidence that our book balance is correct. What happens if they don't clear? That would be where we as auditors step in and we say, it's been 7 days. This transaction is on the bank reconciliation saying that it should have cleared. It has not cleared yet. We need to investigate further why this transaction is not cleared. It may not be a legitimate transaction. All right. So what is the auditor going to do as part of the process here, okay? First of all, it's pretty basic. We're going to verify the mathematical accuracy and agree the balance per books to the general ledger. So remember that bottom line on the bank reconciliation where it says balance per books, that should be the recorded amount in the general ledger for the cash account. Then we're going to agree the bank reconciliation, the bank balance and the reconciliation of the balance shown on the standard bank confirmation. So once we have that standard bank confirmation, that top line that says balance per bank, we want to make sure those match. So that's our first step in the process. We have to make sure that all the items match. We want to compare the deposits of transit to the bank reconciliation on the cutoff bank statement. So anything that represents a deposit, we want to see, did it eventually clear in the cutoff bank statement? We also compared the outstanding checks in the bank reconciliation with a canceled check containing the cutoff bank statement for the proper payee amount and endorsement. So the cutoff bank statement will list out those checks, but a good bank will also send you the canceled checks that we can compare the documents directly to. So we can actually look at the cutoff bank statement and see the canceled check items to see who the payee was, what the whether it was endorsed, and what the amounts were. We also want to agree any charges included on the bank statement and the bank reconciliation. There are some minor items that could clear associated with the bank. Those are bank charges that are not cleared yet. We want to make sure those are cleared by the time. And then finally, agree the book balance to the cash account lead schedule. Okay. So I want to make sure that the book balance is not only just reported what's in the financial statements, but also the cash account lead schedule that we use for our audit purposes. We want to make sure that those amounts match as well. In essence, it's a series of agreements, a series of looking at items, making sure they're all clear. And if they fully clear, then we're pretty happy with this. By the way, verifying the mathematical accuracy. So if we go back to this bank reconciliation, you'll notice that the letter F is here. Does everybody remember what this talked about before? Because I mentioned this earlier. What that is a vernacular for? So it's vernacular for the word foot. Okay. When you see the word foot, that means that we're agreeing for mathematical accuracy. We're just adding things together to make sure they match up. All right. I do want to make a quick note. You will notice that this looks very similar. This slide right looks very similar here to this slide right here, except that I use different terminology. And I wanted to explain that. They like to use the word trace very liberally in the book. All right. And I think that's a bit misleading because that's not necessarily what's going on here. So whenever we're talking about trace, remember that's a source to record match. Okay. We're going from the original source document to whatever it's recorded, or at least the very least to a later source document. Vouching is going from record to source. So going usually from what's our system to the source document, or a later source document to an earlier source document. Agreeing, comparing is basically we're just matching source to source, and usually they're contemporaneous. Okay. So that'd be like looking at the bank account and looking at the back book balance and match or comparing those two side by side. So when you see agree, that's usually going to be a test of VAA, and it's just matching items that are in the contemporaneous documents. All right. So real quick, we do these procedures pretty consistently for every bank reconciliation. We want to make sure we test that bank reconciliation. But what happens if we as auditors discover that fraud may occur over cash? We say that's so unbelievable. Fraud has never occurred for cash. Nobody has ever stolen cash in the entire existence of humanity. That's just unreal. Well, it's possible that it could happen, okay? So what are we going to be talking about when we talk about the what happens with cash? So when the auditor does not have adequate controls over cash, or if the auditor suspects that some type of fraud has occurred, we have additional procedures we need to perform. Now, the good news is that you don't need to know too much in detail about what these represent. You'll look at some examples of these for your homework. But for the most part, these are just additional procedures that we as auditors can perform if we believe that there's problems with cash. So the first of these is called extended bank reconciliation, or we extend the procedure of cash. First of these is extended bank reconciliation procedures. And so all the extended bank reconciliation procedures say is that we're going to test bank reconciliation over a period of time, as opposed to looking at it at a point in time. Because remember, a bank reconciliation looks at one point in time, say end of year, and then test the bank reconciliation as of that date. Extended bank reconciliations will say we're going to do the same thing, except we're going to look over a period of time, maybe 1 month, 6 months, and test count the accounts over that period of time. Next is going to be something called a proof of cash. Okay. So I'm going to test and see how well you all watched the video for 14 and 15 already. So remember, we're talking about property, plant, and equipment. And I said property, plant, and equipment is a very interesting test because every single year we have to go out and we have to look at every single one of the assets, and we have to test every single one of those assets every single year. Does everybody remember that in the lecture? That is not what I said in the lecture. Okay. Again, if you nodded right now, I caught you off guard. All right. It's not what I said in the lecture. What did I say in the lecture? I said that if we've tested in a previous year, we can take that balance as given in the previous year, and then we can test all the additions and disposals. Okay. That's actually how we tested property, plant, and equipment, is that we actually just test based on what has changed from the previous period. Because we know the beginning balance. If we test them in ending or the changes during the period, we can verify the ending balance. So by the way, if you haven't watched 14 and 15, spoiler alert. Okay. Yeah. Anyway, so yeah, same idea holds with a proof of cash. Instead of actually trying to test the cash balance at any period of time, we look at the beginning balance and test the changes in an account over a period of time to make sure we can validate the ending balance. So it's very similar to the way that we test fixed assets that I talked about in the lecture. All right, and then finally, we have test for kiting. Test for kiting are very rarely used anymore simply because of how fast transactions used to occur. But these were very common, kiting schemes were very common back when people wrote a lot of checks, simply because they can make bank transfers and they could say, I have cash in one account, but it hasn't reduced from another account yet, so I can overstate multiple accounts simultaneously. So tests for kiting are very confusing and very, very detailed. The good news is the kiting is not really a scheme that exists too much anymore. It's very rare for it to take place. So we're not going to worry too much about what that represents. So by the way, you don't really need to know what these are. You just need to know the names of these. These are additional procedures that we perform if we suspect fraud or if we need additional test of controls over cash. Or sorry, if we need to test or to extend procedures for inadequate controls over cash. All right, some additional notes. All right. Auditing a pre-impressed cash account, so like for payroll or branch account, they follow the basic same audit procedures. So we don't need to worry about talking about new procedures. Also, we've got this thing called petty cash. Has anybody heard of petty cash? Yeah, petty cash is just rude cash. It's very petty. It's very petty. Petty cash is used to pay for small minor expenses, hence the name petty cash. Okay. And for the most part, we don't have substantive procedures to test cash because it's usually not a material account. Usually what we're going to do is we're going to make sure that we test controls over this, particularly segregation of duties. Whoever has custody does not have the recording and authorization of functions over petty cash, simply because it's easy to bypass. There's an old movie. It's like, it's actually, when I say old, it's like early 1990s movie, which I don't like to think of as old because I was a kid back then. But yeah, it was a very old movie called Don't Tell Mom the Babysitter's Dead. And it's Christina Applegate. She was back when she was teenage, early 20-something actress. She's kind of the main protagonist. And one of the whole themes of the story is that she gets a job as a organization as a much older person. She's pretending to be a much older person. And so she steals a whole bunch of petty cash and then gets away with it because she's the hero in the story. So that just tells you if you go back in the 1990s, it was okay to steal petty cash. Anybody could get away with it. That's the theme of the movie right there. Also the babysitter died. Yeah. I'm rambling. Okay, let's go. So disclosure issues of cash. Auditor must evaluate several types of financial statement disclosures related to cash. So what are some of the most common ones? Defining cash and cash equivalents. When they make sure the policy for that is stated in the financial statements so everybody knows what a cash equivalent is. We need to note if there's any restrictions on cash, such as sinking fund requirement. A sinking fund is an example of an account that's set aside for a specific purpose, but it's usually for something in the future. Like if they're setting aside cash so they can actually finance a building or purchase a piece of equipment, that would be a sinking fund. One big one is contractual obligations to maintain compensating balances. These usually occur when loans are in place. A bank might say, if you're going to take out a loan or a line of credit with us, then you have to have an account with us that maintains a certain balance, and you can't actually go below that balance. Cash balance restricted by foreign exchange controls and any letters of credit that the bank may have, or the client may have. So that pretty much does it for cash. Okay, not a lot to cash. As I said before, testing cash is very easy. Anybody can do it. If I were to ask you how much access to cash you have right now, I don't think that would be a particularly big difficult chore. But we do need to be very aware of with these procedures, simply because it is one of those areas that's very subject to fraud. So we need to understand the different nuances of testing for it. The last thing we're going to talk about is we're going to talk about investments, which are a little bit more obtuse, a little bit more opaque. Okay. When we talk about investments, we talk about common stock, preferred stock, debt securities, hybrid securities, anything that the company could invest in. This is probably should be updated to talk about crypto assets, even though technically speaking, FASB calls crypto assets as intangibles, but organizations tend to classify them or treat them as investments. Anyway, however we're going to treat them. For a client with a large investment portfolio, the auditor is likely to follow a reliance strategy. So if their nature of their business is to maintain investments, okay, like they're a mutual fund or they're an investing firm, and that's their whole line of business, then we are going to have to do testing of controls, okay? For most organizations, though, investments are an ancillary line of operations. This is not something that they do as their normal operations. They may invest in items or have investments, but that's not their main line of business. So, and my tend to go to is like Walmart, Amazon. They're not investing firms. They're retail sales firms. Okay. So for a client that does not require an audit of internal control or financial reporting, it's usually more efficient for the auditor to follow a substantive strategy. So again, that was the ray gun dance that we did back with the last lecture. Another spoiler alert, in case you haven't watched the previous lecture. We're finally to substantive strategy. So what does that entail? Basically, what that means is that we can identify the transactions that are listed in this area, and it's much more effective for us to just test the transactions themselves than the controls, okay? That being said, controls can be really important and prominent with respect to investments, particularly if we think about that their investments are as they're related to controls over financial reporting. So we do need to take a quick stop and talk a little bit about what are some concerns with respect to controls we have our investments. So for completeness, we want to make sure controls ensure that all security transactions are recorded. Existence occurrence, very important, very important. Controls ensure that purchases and sales are properly or investments properly initiated. Okay. Authorization is listed here, and I don't know why. I've been meaning to remove this for like years now. So you can probably ignore this, but I want to make sure investment is properly authorized. That's probably more should be listed under existence occurrence rather than authorization. But yeah, kind of falls into the initiation process. What about VAA? Well, for VAA, we want to ensure that controls the appropriate amounts are used to value investments for financial statement purposes. This one's an important one that we're going to get into a little bit more detail later, simply because VAA is a very critical assertion in this area. Presentation, so we want to make sure they're properly presented and disclosed. And the classification is one that's really, really interesting. It's very nuanced because controls are going to ensure that the items are properly classified. Now, you'll notice I did not list cutoff here. For the most part, cutoff testing of controls is not something that we have to worry about as auditors. We're more concerned about primary assertions in these areas. We're going to be very concerned about existence occurrence, very concerned about classification, and very concerned about VAA. And we're going to talk about more of those when we get to the substantive testing here in just a second. I will say that with respect to controls, that even though the controls themselves are not really that prominent, if we do have to have controls over investment, we do want to make sure that that true segregation of duties is present. Okay, and this is something that we talked about for stockholders' equity in 14 and 15, is that if controls are relevant, then true segregation duties need to be present. And the reasoning behind this is pretty straightforward. Initiation function should be separated from the final approval function. So initiation would be a recording function. This would be an authorization function. So if one individual is responsible for both initiating and approving securities transactions, fictitious transactions can be made or securities can be stolen. So a lot of those are kind of consistent with what we've talked about before with respect to custody, authorization, or recording. We just want to make sure the transactions are legitimate, particularly in areas where existence can be a concern. That's one of our big segregation of duty areas, is when existence violations can be a problem. Keep in mind, when we're talking about investments from this perspective, we're talking about investments as assets. And remember when we talked about this a little while ago back in revenues and purchases, I said if it's an asset or it's a revenue, our primary assertion concern is existence occurrence, okay? What did I say, by the way, for liabilities and expenses? What's our primary assertion concerned? Completeness, yeah, completeness, yeah. And just a reminder, so assets and revenues, primary assertion is usually going to be existence occurrence. For liabilities and expenses, it's usually going to be completeness. It's not 100% true. We're definitely going to have situations where we might be concerned about VAA more, but as a general guideline, that's going to be our goal, okay? All right, substantive available procedures can be used to evaluate the overall reasonableness of investments or related income statement accounts, particularly those income statement accounts, because just as we noted that certain accounts can be derived from our liabilities in the last lecture, we know that they can actually be derived from any investments we have in this lecture. So we can do trend analysis, comparison of balancing the current year's investments or the prior year's balances. So easy trend analysis there. We can also compare current year interest and dividend income with reported income for prior years and expected return on those investments. Probably most importantly, we could recompute current year interest income using the face amount of securities held, the interest rate, and the time period held. So in the last lecture, remember we talked about how to calculate interest expense based on what the value of the debt is. We can do the same thing with our investments in debt securities. If we know what the face amount of the items are, what the interest rate is, and how long the period of time has been held. we can actually recompute the interest income in that. The same logic holds as well. All right. Some of the suggested details, we are concerned about primarily all of the assertions in this area. That being said, some of these are definitely going to be more important than the others. So with respect to investments, our very most important assertion, the top assertion that we're going to be talking about is going to be existence occurrence. Because this is an asset, we are concerned about the overrepresentation of asset with our organization. So there's two possibilities with respect to the way that we can actually test this, all right? For the first one, if the client holds the possession, has the physical possession of the securities themselves, we as auditors can go in and we can inspect those items directly. We can actually look at the items, we can look at the securities, look at the conditions, the details of securities. We can test those by inspecting those documents directly. So inspection of records of documents, looking at those records and making sure they match exactly what we're looking at, okay? So it's going to be a physical examination. That only occurs if our client has access to those securities or has ready access to it. Like if they have the safe deposit box, then we as auditors can go to that safe deposit box with the client and examine those physical securities directly. But what happens if the securities are being held by a third party, say like by the issuer or the broker or some independent custodian, which happens in a lot of scenarios? That scenario, excuse me, it may not be practical for the auditor to actually look at the securities physically. So we may want to actually send out a request to a third party. What do we call a third party request? A confirmation, okay? So we confirm with the issuer, confirm with the custodian, confirm with the broker dealer, okay? We can also read any executive partnership or similar agreements. So this would be information that's sent out to management of the board of directors relating to the investments to verify their existence. But our primary goal is going to actually be to physically examine the items directly, or in lack of that, get confirmation from whoever has physical possession of those securities. All right, I alluded to another assertion that was really important, VAA, all right? I said VAA was particularly important in this area. So one of the things that we need to know about is we need to know about fair value of the investment. You've heard that term fair value. What is the accounting rule, currently generally accepted accounting principles rule for investments? For the most part, investments have to be marked to their fair value, correct? And if there's any losses that go below fair value, they have to be marked down to whatever that new fair value is. Now, I know the rules are a little bit subtle. I'm simplifying something that's a really complex area, but for the most part, that's what we have to note. We have to know what fair value of investments are, particularly if they're being held in investment. So our primary question in this area is going to be, have there been any changes other than temporary to the fair value investment? So what if our fair value has gone, our client's fair value of an investment goes significantly below cost? Well, in that situation, the investment value is determined to be impaired. Security should be written down and a new carrying amount established. Now, again, this condition exists predicated on what the nature of the investment is, which we're going to talk about here in just a second. But for the most part, if we note as the auditor that they're holding an investment on their portfolio that's well above what its current value is, we are going to insist that they write down the fair value to whatever that amount is, even if it's below cost. So with respect to classification and presentation, keep in mind that we generally classify our investments within the FASB guidelines as 1 of 3 types: held to maturity, trading, or available for sale, okay? And then the rules are different depending on what type of category investments they're held for. So held to maturity and available for sale securities should be classified as non-current assets unless management expects to convert them to cash within 12 months. All trading securities should be classified as current assets. Now, why is this important? Why is this an important concern? We've talked a little bit about covenant violations. Remember covenant violations that we talked about earlier? So the banks insist that you actually have to maintain certain covenants. Some of those might be liquidity ratios. And so if they actually misclassify certain types of investments, they can misrepresent the liquidity position. But also the accounting rules are a little bit more distinct with respect to the different types of investments, simply because certain types of investments are treated differently based on what their value is. We talk about a current asset. If it's written down, then it's written down as a ordinary expense. If it's something that's considered to be available for sale, then it's going to be something that goes on to OCI, and then held to maturity. I think I'm getting that right. It's been a while since I've done that. And then held to maturity, I think is let's see, held to maturity, I think is written down. It's not recognized until after the sale occurs. So don't worry about that. I'm not going to test you on what those are because I don't remember myself. But it's important to note that when we talk about whether their classification is correct is really prominent because the accounting treatment is important for determining what the accounting activity will be in that area, particularly with respect to non-current versus current assets for the reasons that we talked about before. Something that's important to note when we talk about fair value can actually be very, very challenging with respect to how we actually determine fair value. So FASB ASC, Accounting Standards Codification Topic 820, fair value hierarchy actually has 3 levels, okay? Now, the first of these you've probably heard fairly quite frequently is mark to market. And this one's pretty straightforward, okay? This is the quoted market price for a given security. So say I'm talking about Amazon par value stock, okay? I can actually go into a website and I can look at, see what the current market value is at a given point in time, and that's what I can quote the value for the stock is in my investments. Again, if I'm holding an investment as an asset, that's the value I can hold it at in my financial statements. That's an easy one. That's pretty straightforward. Mark to market is just basically saying whatever the market value is for that particular investment because it has a market for that investment. Then we have second one. How many people have heard of mark to matrix? Any BSIF folk in here who have heard of mark to matrix or mark to model? Let's say advanced terminology stuff. So mark to matrix is a little bit more subtle. It's distinct. There is not a current market for whatever the investment is, but we can value it based on the price of similar investment items, based on similar securities in the market. So we've got shares in a particular company that's not publicly traded, but we can look at a publicly traded company about the same size and the same activity, and we can say, this is the value of their market, and we can use that to value this particular item. You can kind of see there it's not perfect. We don't have an exact measurement item. We don't have an exact measurement protocol, but we can actually guesstimate. The third one is called mark to model. Mark to model says there's no market, okay? It's not being sold actively in a market. There's no similar asset that represents it. So the valuation is entirely based on subjective management judgment. So basically management estimate is going to be what we actually make the determination. Now, the problem with this is that the good news is most of the valuations of investment securities in the United States are going to be level 1, okay? Mark to model or mark to market, okay? Which is good because we tend to think that's a little bit easier to understand. That being said, there are investments that fall into level 2 and level 3. And as we get further down to level 2 and level 3, the more subjective we get. Now, how do we as auditors feel about subjectivity? Generally not a fan because subjectivity leads to manipulation and it can lead to outright misrepresentation. So if we're going to be moving to subjective levels, we have to be more and more careful and insistent that we understand what are the assumptions that go into developing the estimate. All right. Final concerns. So AUC 540, auditing accounting estimates, including fair value as accounting estimates and related disclosures, specify auditors should do the following. Want to obtain an understanding of how management makes the fair value measurements. We've already talked about this in the previous slide. This is really important to understand, especially if we're talking about much more subjective estimates. Mark to market is very, very transparent. It's very easy to follow. Mark to matrix and mark to model, those are going to be much more challenging, okay? We also need to consider whether specialized skills or knowledge are required. How many people think that they're very specialized in actuarial estimations? Probably not. Has anybody done a Black-Scholes model estimation or evaluation before in one of your classes? It's not something that's traditionally associated with a business model, even though we see those and we hear those terminologies. We may have to actually employ an actuary. I can't believe I just said that. We have to employ an actuary to be able to do the analysis for us. Also, we want to test the entity's fair value measurements. Again, this is subject to what is the basis of the fair value measurements. If it's mark to market, it's very easy. If it's mark to matrix or mark to model, it's going to be a lot more challenging. And then evaluate the reasonableness of the fair value measurements. And if we can actually make a determination that they are reasonably stated, then we can actually determine that they're free from material misstatement. That's the ultimate goal right there. That does it. That's all that we've got for you for this course, okay? We got homework on Friday. We got test prep on Wednesday. I'll see you all then.